Time for this week's stock picks. I'm going to go first. Joy Global. Now, I like Joy Global, and I use Caterpillar as my model here for the way Caterpillar is able to expand and exploit the global commodity trends. And Joy Global obviously manufactures underground mining equipment and surface mining equipment. You're talking to get coal, copper, ore, even oil sands, and obviously gold. Joy Global, only a $10 billion company. I'm not saying it's going to grow to become the next Caterpillar, but it is the last standing U.S. manufacturer of mining equipment. And in Milwaukee, they're close to Canada. What have you got in Canada? You've got tons of these resource companies. This is the resource decade. I think Joy Global will still command a premium here as long as we don't go into a recession and kill the resource rally in the short term. But this is a global mega trend. Joy Global trading at a 12.5 forward PE right now. It's still a 20% earnings grower. All right, Shiraz.
My pick is a play on two of the themes that you surprisingly touched on today. It's a resource play, Williams Company.
Okay.
And also it's the shrink to grow theme that you referred to earlier. So Williams is a portfolio of basically two businesses, exploration and production company, and also one of the largest pipeline companies in the country. They are splitting their company up. They're going to give the E&P business as a stock dividend in a few weeks' time. So it's an excellent value play, giving you two stocks for the price of one. They recently guided that the remaining company, Williams, will be increasing its dividend in the 10 to 15% range over the next few years. So an excellent energy infrastructure play that gives you two stocks if you buy it now.
Nice. Two stocks for the price of one.
That's right, two for.
Not a gimmick, Steve.
Yeah. I'm going for Insperity. After the improvement in the employment reports the last couple months, I do believe that there will be a solid follow-through on this. This is a firm, they're not exactly a staffing firm. It's called a professional employment organization. So small companies, they use them to help, like with the HR, to do benefits and insurance and things of that nature. And really the employees are employees of that firm, okay, of Insperity, and they kind of like lease them back to the company. So it's kind of a play on the employment growth. The company has got a pristine balance sheet sitting on $9 in cash per share. People are looking for $1.67 in earnings next year, and this company is only trading at 25. So I think that, you know, I've seen a lot of analysts saying 35 to 40 is quite reasonable for these shares. I think it's a great value play, and, you know, with the employment trends, I think it's very positive.
All right. Kev.
All right, let me make this short so I don't get Steve on. Mine is going to be Abbott Labs. It is ticker ABT. They are a global healthcare
Another
company.
shrink to growth concept.
I don't think this is shrink to growth. I think this is grow to grow. So
okay.
Check it out. They have a great story. But first off, they have fantastic growth rates, and they are projected to grow their earnings by another 10% for each of the next 2 years out. Great valuations. They also have a fantastic dividend, 3.5%. But when you look at their expected split, which is going to happen at the end of 2012, they're going to break up into two companies. One is going to focus in on medical devices. The other one is going to focus in on research and the pharma division. But if you look at it, both companies are going to be pretty close to equal in size. The medical devices company currently does about $22 billion in sales, which is roughly 54% of the aggregate sales. Pharma is going to be $18 billion, that's roughly 46%, but the pharma side has a fantastic pipeline, and I think if management can really focus in on those core competencies, I think both of those separate divisions are going to grow even more. They have been in a large base for a while. If we can break through 55, I see the market getting to $68 before the split happens in 2012. That's a 23% gain. And don't forget, you still got that extra 3.5%
Yeah, and
dividend.
I think Wall Street likes the medical devices separate because you've got two growth stories there, aging populations
Right.
and emerging markets where
Right.
they're getting 40% growth.
Yeah, 50% of their business comes from international business. Europe is going to weigh on them a bit, but the opportunities in Asia and Latin America, huge.
All right. That's it for this week. Thanks for joining us. Back next Monday.